So, flow-through entities, also called pass-through entities oftentimes. These are entities that report their income and expenses on a separate tax return. They don't pay taxes themselves. They file the tax return simply to report the income and expenses so that we know what their net income is. And then the owners of those flow-through or pass-through entities are the ones that report the income on their personal tax returns. So here's how this works. Let's say we've got a partnership A, and it has 3 partners. Partner 1, partner 2, partner 3. Partner 1 owns 50% of the partnership. Partner 2 owns 25%. Partner 3 owns 25%. When we get to partnerships, we'll talk a little bit about how those percentages are determined. But for right now, we'll just give these numbers. So during the year, Partnership A had income of $150,000 and expenses, deductible expenses of $50,000, and it had some investments. So it had some dividends. The partnership, we're talking about the partnership here. So dividends, qualified dividends of $1,000, and it had some interest income of $1,000. I'm making these simple so that I can calculate easily. And it had some short-term capital gains of $1,000. All right. This is the partnership itself. I'll show you how this is reported in the form that it's all reported on. These are the owners. What happens, so this is the ordinary income from the partnership, $100,000. That ordinary income, the partnership doesn't report it. Well, doesn't pay tax on it, I should say. They report it on their tax return. Partnerships file a Form 1065. Individuals file a 1040, partnerships file a Form 1065. All of these items, so when the partnership is doing its tax return, it's calculating all of this. And it's filing its Form 1065, but it's not gonna pay tax on any of it. What it's gonna do is it's going to report all of these items of income for each individual partner based on their ownership percentage. So, partner 1, so we've got all these different types of income. Ordinary income, we've got dividends, qualified dividends. We've got interest, income, and we've got short-term capital gains. Partner 1 has $50,000 of ordinary income and $500 of qualified dividends, $500 of interest income, and $500 of short-term capital gains. Partner 2, $25,000, $250, $250, $250, and again, $25,000, $250, $250, $250. These short-term capital gains that then flow through, pass through to the partners, will combine with any losses that they might have. That whole netting process, this gets included in that whole netting process. So if partner 1 had $500 of other losses, capital losses, they can combine that $500 of income with the $500 of other losses, and now they have 0. capital gains. Partner 2 doesn't have any other capital losses to offset. They're gonna pay tax on that short-term capital gain. Partner 3, maybe they've got other capital gains. That's gonna add to their capital gains. So whatever, it retains the character. The character of it does not change. So, qualified dividends, again, these are gonna show up on the Form 1040. They're gonna combine with other qualified dividends that they got from other sources. Same as the interest income. Ordinary income is gonna show up on the Schedule 1. And it's gonna be taxed at whatever their own tax rates are. So let's just say that partner 1 makes a lot of other money from other investments and maybe work and that sort of thing. Maybe they've got their own business, and they're in the 37% tax bracket. That means that this ordinary income, this $50,000, is going to be taxed at, if it's marginal, if all of that falls within the 37% tax bracket. We'll assume that all of it does. That's going to be taxed at 37%. Qualified dividends, if they're at the highest level, that's going to be taxed at 20%. Interest income, 37%. Short-term capital gains, let's just say they don't have anything to offset it, so that's also going to be 37%. Because we're in the 37%, and it's short-term, so they don't get the benefit of the long-term tax rates. But partner 2, they don't make much other money. They're in the 12% tax bracket. So this can be taxed at 12%. Qualified dividends, that's going to be 0. Because their income, other income is low enough. Interest income, 12%. Short-term capital gains, let's just say that they've got other losses to offset it. So that cancels it out. And then partner 3, maybe they're 22%. And this is 15% qualified. And this is 22% because they don't have anything else, and 22%. So the same income from the same company is going to be taxed differently for each partner. They're each going to pay at their rates. It's going to combine with other income that they have on their tax return. So like the capital gains with the netting. It's going to be treated differently for each individual partner. But all of it then, that's where the term flow through, pass through comes from. It all passes through to the partners, and they pay at their own tax rates. The form that it gets reported on, this is pretty much everything that I just talked about here, is called a K1. I'm not gonna go through that. Oh, also, so you might have things like, you might have deductions as well that pass through. So let's just say that the partnership also had a charitable contribution of $10,000. Well, that deduction is going to flow through to each of them. So charity, they'll get, partner A gets a $5,000 deduction, $2,500 and $2,500 deduction for charity. That passes through to each of the partners based on their ownership percentage as well. But okay, partner 1 itemizes their deductions. Great, they can take that $5,000. Partner 2 doesn't itemize their deductions. They don't have enough expenses to itemize their deductions. They don't get any benefit from that $2,500 because they don't have a Schedule A. So it goes nowhere. There's nothing for them. Schedule, maybe partner 3 does itemize and they get the $2,500. But it's going to be based on each partner's individual tax situation. 179 expense as well. So if there's a 179 expense, that gets distributed on a per partner basis. And that whole limitation, that 179 limitation, remember we had a limitation, that is combined with other 179 expenses. And so individual partners may have that, the 179 they may not be able to use it because of their own other items on their tax return, okay? Let's see. I'll talk about guaranteed payments in a minute. I just want to show you what the K1 looks like. So this is the form K1. For every type of pass-through entity, partnership, S corporation, estates, trusts, they have their own K1. You can see right here, this K1 is specifically for partnerships. Form 1065, right up here. S corporations, whoops, have a different form. I mean, it looks very much the same, very similar, a few little differences because there's a few peculiarities, differences between partnerships and S corps. But S corps have their own K1, estates have their own K1, trusts have their own K1. Any pass-through entity has their own K1. So you can see everything on the left-hand side here is about the partnership and then about the partner. So it's kind of like a 1099 or a W-2. It's just reporting that information. Partners get these hopefully in time to file their tax returns, but oftentimes they do not get them in time to file their tax returns, so they have to file an extension. They are due, the original due date for S Corp and partnership returns is March 15th. That's supposed to give then a month for individuals to file their personal tax returns by April 15th, but oftentimes these businesses will file extensions themselves. And so if the K1 is not prepared by April 15th and not ready, then the individual partner cannot file their tax return yet, and they have to file an extension. It can cause a lot of uncertainty with regard to taxes. It's hard to plan, especially if you don't know what the K1 is going to show, right? If you have no idea what kind of income is going to be reported, if partner A was not expecting to have $50,000 of income reported to them, now all of a sudden, bam, they've got $50,000 of additional income that they're going to have to pay tax on. Anyway, so information about the partnership, ownership here. So this partner is a 40% owner. Capital accounts, we're not going to get into really that stuff. We'll get into it a little bit when we get to talk about partnerships. But you can see each type of income has its own box up here. So our ordinary income, that would go up here. Ordinary business income, just from operations, that's what we're doing. Rental real estate income. So if the business has a rental property or is generating rental income, then that's going to be reported there. That's going to flow through to the Schedule E for the partner, right? So it's going to flow through there. Guaranteed payments, I'll talk about that in just a second here. Interest income, ordinary dividends, qualified dividends, so just like on the 1099D or DIV. Royalties, so that would be reported on Schedule E. Short-term capital gain or loss, long-term capital gain or loss, collectibles, 28%, all that stuff would then go on the Schedule D for the partner. Unrecaptured Section 1250 gain, remember that from last week? It was a long time ago, I know, but so that stuff, Section 179 deductions. Other types of deductions, I think this is charity. They have codes for them. On the back of the K1 is a list of what all the codes mean. And then, credits, if there are particular types of credits like employee retention credits and things like that, those flow through to the individual partners. Distributions, this is where the owners, if they have taken money out of the partnership, that would be listed here. I'm not talking about income. The fact that they report $50,000 of ordinary income does not mean that they got $50,000 from the partnership. It simply means that is their distributive share of the partnership income. They have to report it even if they got no cash out of the partnership. The partnership is an investment, just like any other stock. And so what happens is the partnership has a basis. Each partner has a basis. Just like if they bought another type of investment, they would have a basis. And once they dispose of it, that basis is going to determine what the gain or loss is. Because they've paid income on, or tax on income, that increases their basis. If they have deductions, it decreases their basis. If they take distributions, if they take money out, it decreases their basis. Just like if you buy a stock for $1,000 and then you sell half of it and you get $500 back out, your basis is now $500. But you don't get, you're not taxed on the $500 you took out unless you had a gain on it. So this is what the K1 looks like. This is where the K1s are reported on the schedule. This is the page 2 of the Schedule E, by the way. And there's a spot, income or loss for partnerships and S corporations. Name of the partnership. Is it a partnership or an S corp? EIN, and then information about down here. I think you've got, in your tax return problem, I think you've got one of these. Like here, it shows the Section 179 expenses listed there, which is right here. That gets entered in on the Schedule E. Non-passive income, 2130, that's the ordinary income, right there. And then the net amount of those, let's see, 5470 loss, and then all of them are combined, and then ultimately it goes on to Schedule 1, line 5. Okay, so guaranteed payments. I said I'd talk to you about these guaranteed payments. Guaranteed payments, partners and partnerships are not employees. If you are a partner in a partnership, even if you contribute services to that partnership, you don't get a salary. You don't get a W-2. What you can get is called a guaranteed payment. And it's just it is what it says it is. It's a guaranteed payment. So if you provide services to the partnership and you're paid, say, $1,000 a month for those services, you will have $12,000 of guaranteed payments. Those guaranteed payments are subject to self-employment tax, but they're also deductible to the partnership as though you were an employee. Okay, distributions are not deductible. Distributions are like dividends, kind of. They're from the earnings of the partnership, and so they don't get a deduction for that. But guaranteed payments act as like a salary from the partnership. There are a couple of things. It reduces the ordinary income of the partnership, but it cannot be, it has to be guaranteed. It can't be based on income. It can't be, we're gonna give you $1,000 a month as long as we have, $100,000 of income in the year. It can't be based on that. It has to be guaranteed. That's the name. Let's see. And like I said, self-employment tax. Partnerships are just Schedule C businesses that are owned by more than one person. So all the same rules apply. It's just that it gets a little weird when you put it into this separate tax return. So because they're the same, it's just a Schedule C business, this income, like the ordinary income, is subject to self-employment tax as well as those guaranteed payments. So these partners, if they're providing services, excuse me, whether they're receiving a guaranteed payment or not, they're going to pay self-employment tax on this ordinary income portion. Just as though it was a Schedule C, right? This is what would be on line 31 on their Schedule C. So just like with the Schedule C, they're going to have to pay that. This is again the part of the passive stuff. So you can tell if it's a passive activity, that means it's an investment, and then it wouldn't be subject to self-employment tax. It would be limited partner would be checked here if they were passive. That means, like I said, all the partner's doing is giving money to the partnership, investing in it. You guys do your thing. I'm not going to provide any services. I just expect you to make me some money, right? What else do I wanna say? Oh, this is just kind of about the losses. I'm not gonna go into that, you can read that. That part. I don't think you've got any problems based on that. Questions? We're gonna get a lot deeper into, especially partnerships. We touch upon S corporations a little bit. We talk more about C corporations than S corporations. But S corporations and partnerships are very common forms of business organization. So, do those in the last part.